Hey friends, welcome back to my channel. I'm Joe, and today I'm here to debunk some of the most common credit card myths. And the reason is that many people still stick to the wrong information, which negatively affects their credit score. By the end of this video, you will learn the most common misconceptions many people have around credit card usage, avoid common pitfalls, and most importantly, build credit over time. And if that's what you are interested in, I would recommend you to stay until the very end. And now let's get started. The first common false belief about credit cards is that carrying a balance will help with your credit score, but that is not true. If you carry the balance to the next statement cycle, you will be paying interest on the remaining balance. In fact, the interest rates on credit cards are one of the highest rates in the United States. For example, let's say you have a statement balance of $500 and you only pay the minimum balance of $25 for this statement cycle, then you will be paying interest, a high interest on the remaining $475. So you will owe the bank $475, which is the remaining balance on your account, plus a high interest on that remaining $475. If you keep carrying the balance to the next statement cycles, then you will be paying interest over interest and you will end up drowning in debt. And here is a tip to avoid paying interest on your statement balance. I would recommend you to pay the statement balance in full by the due date every single month to avoid any interest charges on your credit accounts. Coming up as a second false belief is that closing or canceling your credit card can improve your credit score. This is quite the opposite. Actually, it can lower your credit score, and here are the reasons why. First, closing the credit card that you have been using for several years can hurt your credit score because you are removing the credit history that you have maintained in your credit report. According to myfico.com, credit history accounts for 15% of your credit score. And so the older your credit account is, the better your credit score would be. Second, by closing your credit card, you are reducing the available credit limit on your credit profile. This will ultimately increase the credit utilization, which accounts for 35% of your credit score. If you're wondering what credit utilization is, it is the ratio of the credit that you use to all the available credit on your credit report. Therefore, when it comes to credit utilization, the lower the rate, the better your score would be. It is recommended that you keep your credit card usage under 30% of the available credit limit given to you on each card. Having a good or excellent credit score is a good impression to the lender, especially when you're applying for home loan or auto loan, because you will be getting a competitive rate and you will be saving a lot on interest. So instead of thinking about canceling the credit card that you are not planning to use, I will give you two scenarios so that you can think rationally before making the decision to cancel the credit card. Let's look at the first scenario. If your credit card has no annual fees, then you might as well keep the credit card and keep it active as long as possible, so you can continue increasing credit history with that card. This will help you bump up your credit score as your credit account ages year over year. Now let's move on to a second scenario. If your credit card has annual fee, then you can consider other alternatives apart from closing your credit card account. What you can do is that you can reach out to the customer support of that credit card company and see if you can downgrade that card to a lower tier card, which usually does not have any annual fees. So in this way, you can save money on annual fees. Downgrading to a lower tier card is a great idea because first of all, you are keeping that credit card account active, avoid annual fees on the credit card, and most importantly, build credit history with that credit card over the long term. The next credit card myth that a lot of people are stuck with is that applying for a new credit card can hurt your credit score significantly. Well, it depends on case-by-case basis, and let's dive in on those cases right now. When you apply for a new credit card, the lenders pull your credit history, and this process is called hard inquiry or hard pull. When there is a hard inquiry on your credit report, you will see your credit score drop at first, but over time, the effect of the hard inquiry will fade away, and at that time, your score will go up again. Also, what you should know is that the rate of the score drop is dependent on how many credit accounts that you already have on your credit profile at the time of new credit card application. The more accounts you already have on your credit profile, then the additional hard inquiry might not affect your credit score that much. But if you just started with one credit card and if you are planning to apply for a new credit card, then you will see a significant drop in your credit score. However, you should not worry about it because this is a temporary drop in your score, and if you are disciplined with your credit card usage, then your credit score will go up again. Just a reminder, the hard inquiry on your credit report stays for 2 years, and therefore it is not a good idea to keep applying new credit cards in a short period of time because the new hard inquiries will drop your score significantly. It is also a bad impression to the lenders if they see you are applying for so many credit cards in a short time frame, as they will consider you as red flag when you are applying for a home loan or auto loans. The next myth about credit cards is that having multiple credit cards is bad for your credit score, and this is not always true. Even though there is a hard inquiry at the time of new credit card application with a drop in score, that score drop is temporary. The most important thing is to use your credit cards responsibly and pay off the statement balance in full by the deadline every single month for every credit card that you have. For me, I personally use multiple credit cards for different spending categories. The reason is that some cards give you more cash back on a specific category like gas, grocery shopping, travel, and dining. And also, having multiple credit cards can help you lower your credit utilization, which accounts for 30% of your credit score. Instead of me using $1,000 on my expenses on just one credit card, I would rather split up that $1,000 in expenses into multiple credit cards, probably 2 to 3 credit cards. In that way, I can lower my credit utilization under 30%. Coming up with the fifth misconception that people have around credit cards is that checking your credit score frequently can lower your credit score. This is not true. Only a hard inquiry can lower your credit score. This happens when your lenders look into your credit report when you apply for a new credit card, a home loan, auto loan, or other types of financing options. But there are so many applications that you can use to check your score frequently without affecting your credit score. And this process is called soft inquiry. I personally use Credit Karma to check my credit score, and it has helped me understand how credit score works and how my credit score is performing over the past 3 months, 6 months, and a year. Also, a lot of banks allow you to check your credit score for free if you have credit cards with them. And then you can register your profile with your Social Security on their bank app. In that way, you can check your credit score frequently without affecting your credit score. When credit cards are used responsibly, they are a powerful financial tool to build credit history. It is important to realize that a consistent payment history on the full statement balance every month by the deadline can go a long way and can give you many benefits. They include saving hundreds of thousands of dollars in interest charges, reaping sign-up bonuses of new credit cards, improving your credit score, building a credit history, and getting a competitive rates when you apply for home loans and auto loans. In addition, you as a person will boost financial confidence because you are using credit cards responsibly. That's all for now. If you find this content valuable, please drop a like down below and also comment down below which credit card myth can you resonate with. And also, as a disclaimer, this video is for information purpose only and not a financial advice. So please do your own research before making any financial decisions. I make video content on personal finance, investing, entrepreneurship, and lifestyle videos. So if any of those topics interest you, then please subscribe my channel down below and also hit that notification bell so that you can get updates whenever I upload new videos just like this. Thank you so much for watching, and I'll see you in the next video.